vocabulary highlighted in the book 20 Mistakes Investors Need to Avoid by N. Lankesh. 1. Warren Buffett's Don't Lose Money principle underscores the importance of capital preservation in investing. It suggests that investors should prioritize avoiding losses over focusing solely on making gains. 2. By investing in companies with solid financials, competitive advantages, and growth potential, investors can reduce the likelihood of losing money due to the company's intrinsic strength. 3. In essence, Buffett's Don't Lose Money principle emphasizes the importance of prudent decision making, thorough research, and a focus on long-term value creation rather than short-term speculation. 4. All I want to know is where I'm going to die, so I'll never go there. 5. He doesn't need to predict where a particular investment will perform exceptionally well. Instead, he aims to identify and avoid investments that have a high likelihood of failure. 6. This aligns with his philosophy of emphasizing risk management and capital preservation. 7. Knowing where you might lose money in stock market investing is like having a map to avoid pitfalls on a journey. 8. Overview of the critical mistakes that can hinder financial growth and provides actionable strategies to avoid them. 9. The book also emphasizes the significance of patience, discipline, and a long-term perspective, key principles that have contributed to Warren Buffett's remarkable success. 10. Readers can pave their own path to becoming more informed, confident, and successful investors. 11. While ACE investors may be highly skilled and successful in their own right, their investment strategies may not align with your risk tolerance, financial goals, or time horizon. 12. He assumed that if the ACE investor had made millions, he could too, simply by mimicking their moves. 13. Jack's lack of personalized strategy left him vulnerable to market volatility and exposed him to undue risk. 14. Leaving Jack's portfolio in shambles. 15. They had their own plan to weather the storm and were not responsible for Jack's investment choices. 16. While ACE investors can provide valuable insights, it is crucial for individual investors to conduct their due diligence and develop a plan tailored to their unique circumstances. 17. The information disclosed by ACE investors through public channels is often delayed. 18. Enthralled by their track record. 19. He assumed that by following the ACE investors' timing decisions, he too would enjoy significant gains. 20. Lacking the ACE investors' deep understanding of the market dynamics and their timing strategy, Gibbs panicked and sold his investments at a loss, fearing further declines. 21. ACE investor might have made the right decision to stay invested. 22. While ACE investors might have honed their timing skills. 23. Fueled by the allure of quick profits. 24. Ashwin's confidence waned. 25. The market took a turn for the worse. 26. Strategies can lead to financial ruin. 27. However, the practice of overcrowded trades, where a large number of investors mimic the same investment decisions, can lead to unexpected pitfalls. 28. Believing it was a surefire way to financial success. 29. She believed that since so many others were doing the same, it must be a guaranteed path to substantial gains. 30. The surge in demand for the specific stocks and assets recommended by the ACE investor caused prices to skyrocket, creating a bubble driven by the influx of herd mentality investors. 31. Leaving the followers to bear the brunt of the market correction. 32. She realized that relying on popular trends and herd mentality could lead to devastating consequences, and her lack of a personalized approach had exposed her to unnecessary risks. 33. A budding investor. 34. Dravid blindly followed the trades that the ACE investor publicly disclosed. 35. He was ill-prepared to navigate the downturn effectively. 36. Aspiring investors must exercise due diligence, conduct thorough research, and look for complete information before making investment decisions. 37. Should take the time to understand the reasoning behind each investor's strategies. 38. Their achievements and charismatic personas can evoke emotional responses, leading many followers to invest blindly, driven by emotional biases rather than sound judgment. 39. Such an experienced the fear of missing out, FOMO, and felt compelled to immediately invest, fearing that he might miss out on a golden opportunity. 40. He clung to hope that the stocks would bounce back, driven by his loss aversion bias. 41. Hindering her growth as an investor. 42. Do your research. Align with your goals. Diversify. Stay informed. Seek professional advice. 43. Without a strategy, you might make impulsive investment decisions based on short-term market fluctuations, increasing the risk of losses. 44. His lack of preparedness for market volatility further increases his risk exposure. 45. Without diversification, his portfolio is vulnerable to poor performance in any single stock, amplifying the impact of potential losses. 46. Without these safeguards, he faces an increased risk of losing capital and missing out on achieving his long-term financial goals. 47. She doesn't know whether her portfolio is achieving what she wants because she never clearly defined what she wanted in the first place. 48. Her portfolio's outcomes are haphazard, driven by short-term market trends and a lack of alignment with her undefined financial goals. 49. He misses opportunities to buy undervalued stocks during market dips and sell overvalued ones during peaks. 50. Without a strategy, you may be more prone to making emotional decisions driven by fear or greed rather than rational analysis. 51. Some of his investments perform well, while others underperform. 52. She's uncertain whether her investments are performing well or falling short. 53. She's unable to identify underperforming assets or sectors that need reallocation. 54. She doesn't know whether she's investing for retirement, a major purchase, or financial security, which leads to a lack of focus. 55. Due to Laura's lack of a strategy, she misses out on the benefits of compound growth. 56. Are you investing for retirement, buying a home, education, or wealth accumulation? 57. Your risk tolerance will guide your asset allocation and investment choices. 58. Create a diversified portfolio by investing in different asset classes, industries, and geographic regions. 59. Short-term goals may involve safer investments, while long-term goals can accommodate more growth-oriented investments. 60. Stick to your strategy through market ups and downs. 61. Remember, there's no one-size-fits-all strategy. Your plan should be tailored to your unique financial situation, goals, and risk tolerance. 62. Emotions can cloud rational judgment, leading to impulsive decisions. Fear may cause investors to panic sell during market downturns, locking in losses. 63. These knee-jerk reactions can harm the overall investment strategy. 64. As the tech stock's price soared, Sarah's initial thrill turned into euphoria. 65. Unfortunately, the tech stock's meteoric rise couldn't last forever, and the market faced a sharp downturn. 66. Sold her entire position at a significant loss, hoping to salvage whatever was left. 67. Emotions like greed and FOMO can cloud judgment and lead to rash choices that may negatively impact an investor's financial well-being. 68. Emotional investing can be a significant hindrance to long-term financial success. 69. Experience deep regret when those gains were fleeting. 70. Tom realized that his lack of discipline had jeopardized his financial well-being. 71. The story of an investor whose emotions led to overtrading, resulting in significant transaction costs and financial losses. 72. Arun's emotional overtrading had him fixated on short-term gains and losses. 73. This lack of discipline resulted in constant portfolio churn and frequent changes to his holdings. 74. She solely relied on the stock's recent price movement and the buzz surrounding it. 75. She felt justified in her decision and assumed that the stock's value would continue to rise indefinitely. 76. Determine whether the decline was a buying opportunity or a signal of long-term problems with the company. 77. Evani realized that her emotional investing, driven by ignoring fundamental analysis, had led her astray. 78. Sarah's heightened anxiety made it difficult for her to make well-informed decisions. 79. She was plagued with regret and self-doubt. 80. Buoyed by his past wins, he believed he had a knack for picking winning stocks. 81. David put a substantial portion of his portfolio into the speculative sector, neglecting the importance of diversification. 82. That resulting in substantial financial setbacks. 83. Herd mentality. The tendency of individuals to follow the crowd without critical analysis can have a profound impact on investment decisions. 84. She blindly trusted that the collective wisdom of the crowd would lead to profitable outcomes. 85. She sought solace in social media forums. 86. As the dust settled. 87. She questioned her abilities as an investor and wondered if she was cut out for the stock market. 88. The highs and lows took a toll on her mental well-being. 89. Diversification can help reduce the impact of individual investment losses and minimize risk. 90. Before making an investment, establish clear criteria for when you will enter a position and when you will sell. 91. Patience is a crucial trait in investing. Avoid being swayed by short-term market movements and maintain a long-term perspective. 92. Constantly following market updates can lead to knee-jerk reactions. 93. Hot tips are often based on rumors or hearsay, lacking proper verification or substantiated evidence. 94. He understood that speculative advice could be misleading and should not be the sole basis for making investment decisions. 95. Jessica decided to take the plunge. 96. If the investment didn't pan out as expected. 97. He had to act fast to seize the opportunity. 98. When the market manipulators decided it was time to cash out, they started selling their shares. 99. Michael found himself trapped in a pump and dump scheme where he was left with significant losses. 100. This can result in price bubbles and artificial market movements. 101. They risk falling victim to speculative advice and market hype. 102. The price swings left him emotionally drained and with a significant dent in his portfolio. 103. A serious offense punishable by law. 104. His actions were under scrutiny, and he faced the risk of legal repercussions. 105. He faced public scrutiny and criticism for engaging in unethical practices. 106. Successful investing requires integrity, compliance with the law, and a commitment to ethical principles. 107. A tech company that was supposedly on the brink of a major breakthrough. 108. Successful investing requires independence, diligence, and a commitment to developing one's analytical skills. 109. Avoid being swayed by sensationalism or hype. 110. Her portfolio became heavily concentrated in a few trendy stocks, leaving her vulnerable to market volatility. 111. Market conditions changed, and the stocks Olivia had invested in began to experience significant price declines. 112. Concentrating your investments in a few stocks exposes you to higher specific risks. 113. Overcommitting to a few winning stocks without spreading investments across different sectors can leave investors vulnerable to market fluctuations. 114. David's strategy was centered around chasing momentum. 115. As some of the stocks David invested in experienced initial price surges, he felt a sense of validation. 116. Significant price declines. 117. He understood the importance of assessing a stock's intrinsic value before investing. 118. Emotions like fear, greed, and excitement can cloud judgment and lead to impulsive choices that may not align with rational investment strategies. 119. Frequent trading can result in substantial fees and commissions that erode potential profits. 120. The complexity of managing a large and diverse portfolio began to weigh on him. 121. Successful investing requires a balance between diversification and manageable portfolio size. 122. Instead of focusing solely on breakout stocks, diversify your portfolio across different asset classes, industries, and sectors. 123. As the market experienced ups and downs. 124. In the absence of understanding, investors might experience short-term gains by chance, but their lack of knowledge can limit their ability to achieve sustained success over the long term. 125. If you're new to investing, consider starting with index funds or exchange-traded funds, ETFs. 126. Stick to your investment plan and stay patient. 127. Borrowing to invest, also known as leveraging, can potentially amplify both gains and losses in the investment world. 128. While leveraging can amplify gains in favorable market conditions, it also exposes investors to the potential for substantial losses, especially during market downturns. 129. He realizes that while leveraging can amplify gains, It also amplifies losses and comes with financial obligations in the form of interest payments. 130. The value of Emma's investment starts to plummet, and her borrowed funds become a liability. 131. David faces unexpected medical expenses that require a significant financial outlay. 132. He's torn between selling his investments to cover the expenses or finding alternative sources of funds. 133. Leveraging introduces additional risk, which might not align with an investor's risk tolerance or psychological well-being. 134. He's willing to accept higher risk to potentially recoup his losses. 135. The combination of significant borrowed funds and market volatility takes a toll on his emotional well-being. 136. The emotional toll of managing leveraged investments leads to sleep disturbances and difficulty focusing on other aspects of his life. 137. Here are some strategies to help mitigate the potential drawbacks of leveraging. 138. Borrowing to invest is better suited for long-term strategies. 139. Maintain a separate emergency fund to cover unexpected expenses. 140. Consider borrowing only a portion of your overall investment capital. This reduces your exposure to risk and potential losses. 141. This lack of due diligence can lead to investing in companies that might be financially unstable, poorly managed, or lacking competitive advantages. 142. The companies Sarah invested in lacked the financial strength and competitive advantages to weather the market downturn. 143. Companies with strong fundamentals tend to be more stable and can provide a sense of security during turbulent times. 144. Rachel is drawn to stocks that are currently popular. 145. Her portfolio lacks the resilience to weather the storm. 146. Shift your focus from short-term gains to long-term sustainability. Consider the ability of companies to weather market fluctuations and economic challenges. 147. The stock price of this company has been soaring. 148. As a result, the stock's price starts to level off. 149. Overvalued stocks are more susceptible to market corrections, where prices drop to align with their true value. 150. Michael's investment portfolio takes a hit as the stock he invested in undergoes a correction to align with its intrinsic value. 151. He realizes that he underestimated the risk associated with investing in a company with an inflated stock price. 152. A margin of safety provides a buffer against unexpected market downturns and ensures that an investment is purchased at a price lower than its intrinsic value. 153. Value investors seek a margin of safety by purchasing stocks below their intrinsic value. Overvalued stocks lack this cushion, leaving investors exposed to market volatility and potential losses. 154. He recognizes that his investment was vulnerable to market volatility because he didn't account for the possibility of setbacks. 155. If market sentiment shifts, overvalued stocks can experience rapid price declines as investors realize that the stocks were overpriced. 156. The stock price of the company has surged. 157. It will yield substantial profits. 158. The company's inability to meet expectations and deliver consistent growth has a direct impact on the stock price. 159. This newfound awareness guides him toward more prudent investment choices in the future. 160. She is swept up in the excitement. 161. Her emotional decision-making clouds her judgment. 162. Compare these metrics to historical averages and industry benchmarks. 163. Aim to buy stocks at prices that are significantly lower than their intrinsic value. 164. Don't put all your eggs in one basket. 165. The sharp decline in the tech sector's performance results in substantial losses for all of his investments. 166. A concentrated portfolio is more susceptible to extreme price fluctuations. 167. Sophia decides to broaden her investment horizon. 168. Emily's portfolio is heavily skewed toward tech stocks from different companies within the sector. 169. She understands that focusing solely on one sector can limit her exposure to potential high-growth areas. 170. If your investments are heavily concentrated in a particular sector, your portfolio becomes vulnerable to risks unique to that sector, such as regulatory changes, technological disruptions, or industry-specific challenges. 171. It can hinder his ability. 172. He recognizes that diversification provides a safety net during times of sector-specific difficulties. 173. Trying to time the market is notoriously difficult. 174. Jessica's decision to wait for the perfect entry point results in missed investment opportunities. 175. With every buy and sell order, he incurs brokerage fees and transaction charges, which accumulate over time. 176. He embraces a long-term investment mindset that focuses on minimizing trading costs and maximizing overall returns over extended periods. 177. Implement a systematic investment approach by investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy, known as dollar cost averaging, helps you buy more shares when prices are low and fewer shares when prices are high. 178. As Ethan's investments experience rapid price swings. 179. Short-term price spikes. 180. The constant swings between euphoria and anxiety take a toll on his mental and emotional health. 181. Resulting in unrealized losses. 182. Because he wasn't tracking performance, he missed the warning signs of declining revenue and profitability. 183. Ignoring performance means you might not notice when an investment is underperforming or incurring losses. 184. Leading to haphazard decision-making. 185. Identify which investments are performing well and which ones are lagging. 186. Compare your portfolio's performance with relevant market benchmarks or indices. 187. Holding losing stocks and selling winning stocks, often referred to as the disposition effect. 188. This bias stems from loss aversion, where investors feel the pain of losses more intensely than the pleasure of gains. 189. Selling winning stocks too early prevents investors from fully realizing their gains. 190. Even in the face of mounting evidence that its prospects were dim. 191. The emotional toll of seeing her investment decline began to affect her overall portfolio performance. 192. Avoiding knee-jerk reactions driven by emotional biases. 193. Investors should strive to maintain a balanced approach to both losing and winning stocks. 194. Lisa quickly sold her shares to lock in profits. 195. She set clear criteria for when to sell or hold an investment and prioritize maintaining a diversified allocation across various sectors. 196. Mark quickly sold his shares to secure the profits he had earned. 197. His attachment to the losing biotech stock and his eagerness to secure gains from the software stock demonstrated a lack of rationality. 198. They were influenced by his aversion to losses and his desire to experience quick wins. 199. Define clear criteria for when you will sell a losing stock and when you will hold on to it. 200. Maintain a diversified portfolio that includes investments from various sectors and industries. 201. Consider implementing stop-loss orders for losing stocks and take-profit orders for winning stocks. 202. The tech sector was on the cusp of a significant growth period. 203. Reviewing investment plans to seize opportunities for growth. 204. The investments in Alex's portfolio remained geared towards his original goal of saving for a house down payment. 205. James started neglecting to review his portfolio regularly. 206. The underperforming assets had dragged down his overall returns. 207. Allocate specific times on your calendar for regular portfolio reviews. 208. He was more interested in chasing short-term gains than seeking long-term value. 209. To mitigate this issue, it's essential to focus on quality information sources, practice selective consumption. 210. He believes his gut feeling and intuition will guide him to profitable outcomes. 211. Alex doesn't believe in the need to hedge his investments against potential losses. 212. Stick to your strategy even when market sentiment or short-term fluctuations tempt you to deviate. 213. Before making investment decisions, create a checklist of factors that should be considered. 214. Remember that while confidence is important in investing, it should be balanced with humility, rational analysis, and a willingness to learn from both successes and mistakes. 215. You to invest in companies that are lagging behind their competitors. 216. The traditional taxi companies' revenues begin to plummet as customers flock to the convenience of ride-sharing platforms. 217. The company's positive net income is not translating into strong cash flow, as it's spending more cash than it's generating. 218. This example highlights the significance of cash flow analysis in gaining a comprehensive view of a company's financial health. 219. Company might show positive net income on its income statement but still face cash flow problems. 220. Despite its positive net income, the company is facing liquidity challenges due to the lack of available cash. 221. Companies can manipulate earnings through accounting methods, but cash flow is harder to manipulate. 222. Company with negative operating cash flows for an extended period might struggle to meet its financial obligations, potentially leading to insolvency. 223. She is swayed by the company's positive net income. 224. An emergency fund acts as a safety net during unexpected events like medical emergencies, job loss, or major repairs. 225. Sudden health issue required Alex to take a leave of absence from work. 226. Alex found himself in a financially strained situation. 227. The absence of an emergency fund, you might be forced to withdraw from your investments prematurely to cover emergencies. 228. The absence of an emergency fund forced her to compromise her long-term financial objectives. 229. Vowing never to be caught off guard again. 230. Ultimately, having an emergency fund is a critical foundation for any financial plan. 231. Calculate how much you need in your emergency fund. Aim for 3 to 6 months worth of essential living expenses. 232. Treat your emergency fund contributions as non-negotiable.